Gold is crashing. The yellow metal has posted its worst monthly performance since 2008 after touching record highs earlier this year.
But this time, even after a major geopolitical conflict, gold couldn't even touch $5,000. If gold doesn't go up during a war, then something else is driving the market. In today's video, we'll break down why gold crashed, why it's still stuck in a range, and using one simple valuation method, we will analyze whether gold appears overvalued, undervalued, or fairly valued based on this framework. The objective is not to predict the future, but to understand what the data is telling us and how investors evaluate gold using a logical, evidence-based approach. On 20th January 2026, gold has touched all-time high of 5,589 per ounce after delivering an incredible 68% return in 2025. Its best performance in almost 50 years. But then everything changed. By the end of June, gold has fallen below $4,000 per ounce. That's a 29% crash in just 5 months, and today gold is trading around 4,050 per ounce. So what actually caused this crash? It comes down into two words: interest rate. Here is the simple logic. Gold doesn't pay any interest. ये बस value store करता है. That's why gold become very attractive when interest rates are low or falling. लेकिन जून के शुरुआत में the US jobs data come in much stronger than expected और inflation भी expected से ज़्यादा है. The market quickly realized that the Federal Reserve has no reason to cut interest rates. In fact, there was even a chance that the rate could move higher, and that one shift changed everything. Gold did not crash because it suddenly became a bad asset. It fell because the higher interest rate made cash and bond more attractive than gold.
Welcome back now at 5:16. We're taking a live look over Capitol Hill, where just hours ago, the House passed a $95 billion budget proposal. It includes $73 billion for the war in Iran.
Now here the story gets more interesting. Just this week, the US House approved nearly $95 billion in funding related to the ongoing conflict with Iran.
For months, we've been talking about one waterway, the Strait of Hormuz. But there are two vital maritime choke points in the Middle East, and they're both caught up in ongoing conflicts. Now, this is the Bab el-Mandeb Strait, located between Eritrea, Yemen,
the another major development, Houthi rebels in Yemen started attacking oil tanker passing through the Bab el-Mandeb Strait, one of the world's most important shipping routes. That means two of the world's biggest oil choke points are under threat at the same time. Normally, ऐसे situation में gold price sharply rally करता है. But this time the market reacted very differently. This war is pushing oil price up. Rising oil price means rising inflation. And rising inflation fears means the market bet on higher interest rate, not cut. The exact same war that could help gold is actually working against it. This is a real story right now. The gold is not broken. It's stuck in the tug of war between fear and interest rate math. In June alone, gold ETF, the fund that most retail investors buy, saw an outflow of 8.9 billion, making it the biggest monthly sell-off since this crash began. लेकिन इस टाइम में something completely opposite thing is happening. Central banks bought 244 tons of gold in the first quarter alone. Countries like Poland, China, and India were not selling. They are buying. Why? Because central banks do not think in a week or month. They think in a decades. While many investors react to the short-term pricing movement, but central banks focus on long-term strategic reserve. Even the biggest bank forecast cannot agree where the gold price is heading. Morgan Stanley expects the gold price to reach around $4,800 by the end of this year. Goldman Sachs is targeting $4,900 and UBS believe it could go up to $5,900, while JP Morgan see a range that extends to $6,000. But notice something, not a major bank is saying gold price is falling where it is trading today. So who is actually right? Instead of guessing, let's calculate the real gold price value using actual formula. There is a real model analysts use called the real interest rate model. Take 10 years of US Treasury yield. What is left is the real yield. When it falls, the gold price rise. When it rises, the gold price fall. PIMCO owned 20 years of study found every 1% rise in real yield pulls gold real price down by about 8%. What analysts call gold real duration. But that model alone does not fully explain the gold price anymore, because gold price keep rising through 2024 and 25, and even while real yield stay positive. So World Gold Council built a bigger and better model. Their gold valuation framework combines real yield, inflation expectation, the US dollar, and the central bank demand. As of their July 2026 outlook, the model puts gold fair value around $4,100 with a 5% band. That's mean anywhere from 3,900 to 4,300 is considered to be fair. Gold today is trading around $4,050. That's inside the fair value band, just below the midpoints. The honest answer is gold is now in fair value, not cheap but not in a bubble territory either. So does this correction means gold is broken? Not necessarily. Yes, a correction during a major shift in Fed reserve policy can be painful. लेकिन correction और long term trend एक ही चीज नहीं होता है. Look at the bigger picture. Central banks are still buying close to 1,000 tons of gold every year. Gold still represents less than 3% of global investment portfolio, and global debt has crossed 353 trillion, the highest level in the history. In other words, many of the long-term factors that supported the gold have not disappeared. Short-term prices may change, but these structural trends remain largely the same. If you are underweight gold, most of the evidence here say buy gradually. Don't dump your entire saving into one shot. If you are already holding gold, history says stay in the course. Don't panic sell into a fear. Gold has crashed 5 times in the last 50 years. Every single time, the people who understand why it fails and stay patient made more money than the people who panicked. If this video actually helped you to understand gold in 2026, hit subscribe. We simplify real financial data every week. Comment below, are you buying in this dip or waiting it out? Full research report are linked in the description and pinned comment. Cheers.